Israel's strike against Iran sparking a haven rush on this Friday morning. 30 minutes until the start of trading. I'm Katie Greifeld.
I'm Shanali Bassek. Matt Miller is on assignment in France. Bloomberg Open Interest starts right now.
Coming up, a major escalation. Israel strikes Iran's nuclear facilities, taking out its top military command. Iran vowing retaliation, raising the risk of a wider war. That news sending crude higher and driving investors to safer assets. Meanwhile, in Washington, President Donald Trump urges Iran to make a nuclear deal to avoid more attacks. And you're seeing that fallout in markets right now, Shanali.
Yeah, let's take a look across assets to see what's going on, as Katie has been talking about a haven trade building. S&P futures down about 1%. We see Brent crude. This is where a lot of the action is. It's still up about 8%. Remember, it was up about 13% earlier in the day, reaching $78 a barrel. It's about right under $75 now. It had the biggest intraday jump earlier since 2022. Gold as well, because we are going to talk a little bit more about where oil is headed. We'll have more impacts cross asset. Gold is still up about 1.5%. Katie, we're taking a look across all of those moves, the bond market as well. But first, you're looking at some stocks too.
Absolutely. Let's take a look at the single stock level, because energy, defense, and shipping stocks surging, with Exxon, Lockheed Martin, and Zim Shipping just some of the names moving higher in response. Meanwhile, on the other side, travel stocks under pressure in a big way. You can see that United Airlines, Carnival Cruise, and Hilton all lower this morning. Now, Israel's Prime Minister Benjamin Netanyahu pledged to continue with airstrikes.
Moments ago, Israel launched Operation Rising Lion, a targeted military operation to roll back the Iranian threat to Israel's very survival. This operation will continue for as many days as it takes to remove this threat.
President Donald Trump taking to Truth Social this morning, writing, quote, 2 months ago, I gave Iran a 60-day ultimatum to make a deal. They should have done it. Today is day 61. I told them what to do, but they just couldn't get there. Now they have, perhaps, a second chance. Now, this stands in contrast to a statement coming overnight from U.S. Secretary of State Marco Rubio, who said that the U.S. is not involved in the strikes. Joining us with the latest is Bloomberg's chief political correspondent, Anne-Marie Hordern. So, Anne-Marie, specifically, Secretary Rubio said that this was a unilateral action by Israel. The president's words could be taken slightly differently. What do we know?
Well, the UN ambassador, Israel's UN ambassador, came in and joined us today, and he also said that Israel decided to take this unilaterally and they acted alone and by themselves. What we do know, though, is that they obviously gave the United States a heads up, and that was very clear earlier in the week when we saw embassy staff being relieved from the Middle East and sent home, especially in places like Iraq. What I would say now is, actually, when the president says he gave Iran 2 months, I actually reported 3 months ago on March 19th that he had sent a letter to the Ayatollah saying, I'm giving you 2 months and I want to make a deal. It feels like he actually gave the Iranians a little bit more time. They were supposed to have a 6th sit-down of negotiations in Oman this Sunday. That has obviously been canceled. The Iranians saying they are not going to have these nuclear discussions with the United States right now. The president is still kind of saying he still wants a diplomatic path forward, and maybe he's using these current attacks as leverage. We do know that Israel's acting alone, but I would imagine when it comes to Israel defense, the United States will be there.
What position does this put the White House in heading into the G7 meetings?
Well, I think it puts them in a difficult position dealing with some leaders that are already calling for de-escalation, when the president, according to ABC News, in a conversation is saying that this was excellent. He's expecting more to come. We also heard that from Danny Danon, Israel's ambassador to the UN, saying this is going to be days and weeks of attacks. And these attacks are still ongoing. And I think what's most notable about these attacks is it's not just going after Iranian nuclear facilities. It's not just going after its ballistic missile program. It's going after senior military personnel. We are talking about the IRGC, the Islamic Revolutionary Guard Corps commander, and individuals under him. These are key individuals to the Ayatollah, and it also will mean that Iran is incredibly vulnerable, and it's going to be difficult for them in terms of their response level when they don't have this kind of personnel. And Stephen Cook from CFR was on with us earlier, and he was saying that because they're going after this senior level of individuals, it almost feels less like they're trying to halt Iran from being being able to have that capability to create a nuclear bomb, but also that they're going after regime change.
Certainly a lot going on at the same time. Anne-Marie, I'll be keeping an eye on your X handle throughout the weekend before we head to surveillance, of course, on Monday morning. That is Anne-Marie Horder, co-host of Surveillance and chief political correspondent for Bloomberg Television. Now, oil prices are surging, as we've been talking about, on the heels of these strikes by Israel. Joining us now, Will Kennedy. He's Bloomberg's senior executive editor for energy and commodities. You are seeing that Brent crude rise hold to a large degree. Ultimately, we talked a lot about the White House's response, but investors, of course, the world is watching for Iran's response. How might the oil markets respond based on what will happen over the weekend and into next week?
Yeah, that's exactly right, Sonali. Traders are going to be really looking to see what Iran does next. And key is the Strait of Hormuz, this narrow waterway that guards the entrance to the Persian Gulf, over which Iran has significant control, and about a quarter of the world's oil travels through every single day. Now, the great fear of oil markets has been that Iran, in a moment of crisis, would try and close that strait to shipping, and that could see, according to JP Morgan, oil go as high as $120 a barrel. Now, clearly, that's a worst-case scenario. We can see from current prices that that's not expected to happen right now, but I do think there's significant risk to shipping, that we may see a more low-level campaign to put pressure on the global economy from Iran by harassing shipping in and out of the Gulf, making tankers reluctant to go in, forcing up shipping rates, perhaps causing a shortage of tankers. These are the kind of risks that people will be looking for as they try and price crude into next week. It's also important to note that traders are buying protection against worst-case scenarios. We've seen a lot of activity, people buying call options out of the money just to give them that protection against real escalation here.
Well, I'm glad you brought up that JP Morgan call, because it certainly caught a lot of eyeballs this morning. They do assign their simulations a 7% probability to that worst case scenario of $130 per barrel. Their base case is still in the low to mid 60s. And this is something we're going to be talking about throughout the program. The fact that it doesn't feel like asset classes hold on to risk premium for all that long. And you think about past periods of escalation, such as this one, Will, it doesn't feel like oil has been able to hold that bid.
That's right. People buy the risk, but then the risk doesn't materialize and we lose that premium. Throughout all the troubles and escalations that we've seen in the Middle East over the last few years, we have never seen it take out any barrels of oil out of the market. Now, that could change. That could well change here, because these events seem as dramatic as any others that we've seen in recent years. But also there are risks of Iranian barrels coming out of the market in other ways. Sanctions are likely to snap back. The IAEA found Iran to be in breach of its nuclear obligations. The nuclear talks are over at this stage because of last night's action. So even if we don't get military action taking oils out of the market needs to prepare for Iranian barrels coming out of the market, which will be significant, but less significant than something around the Strait of Hormuz.
Absolutely. Will Kennedy, really appreciate your perspective this morning. And let's keep this conversation going now and take a look at some of the equities moving off the back of this latest news coming from Iran and Israel. Joining us now is Bloomberg stocks reporter Nora Melinda. And Nora, we were just talking about oil prices with Will Kennedy, and that's certainly showing up in the equities.
Most definitely. We're seeing a lot of these stocks moving off of this. And of course, I'm looking at energy stocks coming off of the conversation that you all just had. With tensions escalating, we're seeing Brent crude seeing its biggest gain in more than 3 years. We're seeing that pairing a little bit, but I've got eyes on Exxon, Chevron, Occidental Petroleum. We're seeing these gains really driven by fears of a wider war in a region that essentially accounts for a third of global crude production. But I've also got eyes on defense. This is an area that I cover very closely. And of course, we're seeing Lockheed Martin, the likes of RTX, and some of those others in the sector. They are also gaining, of course, as conflict escalations signal elevated military spending. So you're going to see defense being one of the beneficiaries of this trade. But also on the flip side, I'm looking at some names that are in the red, and that's travel stocks. They're under pressure right now. Of course, this is coming after the idea that it could bring down demand for those that are traveling on airlines. If you think of Delta, American, United, we're seeing those stocks that are in the red. But additionally, we're also seeing higher crude prices likely to cause higher jet fuel and operating costs. So those are some of the sectors that we're seeing moving off of this news.
Yeah, a bit of a double whammy there for some of those travel names. Nora, great roundup as always. That is Bloomberg's Nora Melinda. Let's take a look at the benchmark level as well. About 20 minutes ago until the opening bell on this Friday, you can see that risk-off tone really permeating across the indices right now. The S&P 500 down almost 1% in the pre-market. Big tech taking an even bigger hit. The Nasdaq 100 off by 1.3%, and the small caps really bearing the brunt of the losses at the moment, with the Russell 2000 down about 1.5%, Shanali.
Yeah, it's interesting. The S&P 500 on track to erase, it looks like, all of the gains for the week. So serious risk-off attitude. But coming up, we're going to head to France. There's a little bit of risky stuff going on there in another way. Matt Miller, you might miss him on the program today, but he is over in France, and we will be joined by Gil West of Hertz, Adrian Hallmark of Aston Martin. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. Investigators are combing the wreckage of the Air India flight that killed all but one of the 242 people aboard yesterday when it crashed shortly after takeoff. The focus is on determining what caused the Boeing 787 Dreamliner to explode into a fireball, with questions surrounding the plane's thrust and possible misconfiguration or erroneous weight data. The crash is the deadliest aviation accident in over a decade and the first ever complete loss of a 787. The Trump administration can keep control of National Guard troops in California and continue to deploy them in Los Angeles, according to a ruling by a federal appeals court. The decision pauses a lower court ruling that determined President Trump's federalization of the Guardsmen was unlawful. The appeals court will hold a hearing on Tuesday. Protests in LA and other cities have erupted over the questionable tactics used by federal agents to enforce immigration laws. And investors are awaiting the University of Michigan's consumer sentiment data out next hour that could shed some light on how evolving trade policies are impacting inflation and household confidence. Matt Miller sat down with Tom Wagner, the Knighthead Capital co-founder, in Le Mans, France, and asked him what the Fed could be doing to stem inflationary pressures.
I do think the Fed needs to cut. Yes, I don't think that. I think we're below target inflation, and I think that you can make an argument that some of the excess spread and rates that we have, put inflationary pressures on key consumer products like housing and auto. Those are industries that are not doing particularly well at the moment, and I think they would benefit from a cut. And they're critically important industries, not just to the U.S. economy, but to the U.S. consumers.
Let's go now to Le Mans for more, because Matt Miller is standing by with the CEO of Hertz.
Yeah, thanks very much. I do have Gil West here, the CEO of Hertz. And Gil, great to get some time with you. I do want to talk about the business, but first I have to ask about your finish last night. Cadillac 1-2, Hertz Team Yoda locked out the front row for Le Mans. I mean, how did you do it?
It's historic stuff. I'm a big gearhead myself, race vintage, and couldn't be happier. Couldn't be prouder of the team and the partnerships we have. So it's historic stuff at the most historic racetrack in the world.
I always ask CEOs, what's the return on investment when it comes to motorsport? Because it's fun, so I get why you want to do it. A lot of people see it maybe as a vanity project, but does it really feed down to the bottom line? Does your big Hertz logo on that winning Cadillac make a difference at the end of the day?
Yeah, it's racing motorsports, it's part of our heritage. Hertz has been involved in motorsports longer than I've been alive. Me as a customer before I joined Hertz, the 65 Shelby Hertz GT, that drew me to Hertz. So, we're in the car business, and motorsports are central to that.
In terms of your business, we've had some real worries about travel, slowdown in demand, maybe softer numbers than you would have wanted in the first quarter. Do you see that picking up now in the second quarter?
Yeah, I think at an aggregate level, we still see year-over-year growth, as far out as we can see. I think the challenge has been the mix has shifted. So, government travel's down a bit, but leisure travel, which is our kind of highest margin travel, is up. So while the mix may shift, the U.S. inbound, government down, there's other increases in travel as well.
Hertz famously built up its fleet of Teslas before you came on as CEO, and I know you've been working to get them down from, I think, about 100,000. How have you worked through that inventory, and is that part behind you now?
Yeah. Well, I think the whole industry probably went too far too fast with EVs. For us, yeah, we've rationalized our EV fleet and we've reduced it, but more importantly, we've rationalized it around where the natural product market fit for EVs are. So we got a great partnership with Uber and Lyft. So on the ride-hail business that we support, there is a lot of demand for EVs. So we've rationalized most of the EVs that we have around that. We also have them off airport rentals, which is another good product market fit, much fewer at the airports.
You also are one of the biggest sellers of cars. And a lot of people don't know that. They think, obviously, of you as a rental car business. But if we see car prices go up, does that help your business because you can sell cars at a higher price? Or does it hurt your business because you need to replace them at a higher price?
Yeah, I think we look at the buy and the sell. So the difference is what's key. For us, as an example, one of our strategies around our fleet is to sell more vehicles through retail, which then, if you look at what we buy vehicles for, ultimately what we sell them for, you know, it narrows the gap between the two and improves our depreciation. So it's a conscious part of our strategy. You're right, not a lot of people know that we sell cars, but we're one of the largest used car dealerships in the world. So we've grown our capacity to sell through retail channels. We do that ourselves. We digitize the experience. We offer financing, insurance, everything. And then we got great partnerships in that space as well. But as residual values increase, it certainly helps us in the short run.
In terms of, you mentioned the airport locations, obviously, and then off airport is helpful. You're getting a lot more competition right now. What does that do to pricing if you have, say, Sixt coming into 50 airports across America?
Yeah. Well, I mean, competition will always face competition. You know, we're positioned well. We got an iconic brand, been here for over 100 years. For us, we've really focused and leaned into what we call back to basics, but it's running just a great operational excellence along with enhancing our customer experience. So we're differentiated and people want to rent from Hertz. And then from a competitive standpoint, we've positioned ourselves well.
In terms of investors, we just heard from Tom Wagner. You know, he at Knighthead, they have well over 50% stake, I think, in the company. Mm-hmm. And recently we've seen Bill Ackman get involved as well. Does Bill want to call you up? Does he get you on the phone? Does he give you advice?
Yeah. Well, first of all, I mean, we're really happy with his confidence in Hertz and his investment. So we welcome his investment. Certainly welcome all ideas, his included, from all quarters, you know, as we're looking to transform the business. So he's got some great insights, he and his team. So we appreciate all the input we can get.
How do you transform the business? I think of a future where we all get into a car that drives itself. Mm-hmm. Is that a benefit to you, or is that a problem for Hertz in the future?
Yeah, we're of course we're a huge fleet manager, right? I mean, we've got, you know, well over 500,000 vehicles. So if you think about large fleets, asset heavy, footprint to operate them globally, you know, carrying, feeding, maintenance of all those vehicles, you know, we're one of the few in the world that can do this at scale. So we're a natural player in the AV space.
And so how soon do you expect that to happen? When am I going to go to, you know, my Hertz location at John Glenn International Airport in Columbus, Ohio, and get myself a car that can drive me home to Granville?
Yeah, I think it's coming quicker than what we have all thought. You know, it's been leading up to the moment, but I think right now, most major cities in the U.S., you're starting to see not just testing, but commercial deployment. So our aim is to be, you know, one of the key players in that market space.
All right, well, you're certainly one of the key players here at the 24 Hours of Le Mans. It was amazing to see you guys qualify in first and second, lock out the front row. I'll toss it back to you, Katie, in New York. That was Gil West, the CEO of Hertz.
All right, our thanks to Gil West and, of course, our own Matt Miller. Matt will be back with more from Le Mans next hour when we'll hear from Aston Martin's CEO. Looking forward to that conversation. But let's take a check at the setup as we head into the opening bell, because we have futures down pretty mightily right now. The S&P 500 down 1%. Big tech down even more, with the NASDAQ 100 off by about 1.3%. And then the Russell 2000, the small caps, interestingly, are some of the biggest losers today, at least on the benchmark level, with the Russell 2000 off by about 1.7%.
Certainly a challenging trade. And coming up, we're going to talk more about the rising geopolitical risk with Rebecca Patterson. She's former chief investment strategist for Bridgewater. She's now a senior fellow at the Council of Foreign Relations. Of course, a lot of this will be discussed in that council. We'll talk about it with her next. This is Bloomberg Open Interest.
Welcome back to Open Interest. We're checking that risk-off sentiment across asset classes right now. You can see that in the S&P 500, down about 1% in the pre-market. You can see that in Brent crude, higher by about 7% right now, of course, after Israel attacked Iran overnight. But what's interesting to me is that you have two-year Treasury yields higher by about 3 basis points right now, Sonali. There is an interesting conversation to have about what this means for the Fed. If we do get durably higher oil prices from here, that's going to filter into inflation expectations, and that's something that the Fed can't ignore. That might explain the move that you're seeing in the bond market right now, at least when it comes to the short end.
It's interesting. You would have expected a traditional safe haven bid, but instead, to your point, you're seeing yields actually up a little bit. So complicated equation there. We're watching some stocks as well ahead of the opening bell. We're watching energy sector, defense sector, travel stocks as well. ExxonMobil up about 2.6%, right ahead of the market open. Lockheed Martin also up almost 2%. The travel stocks are really interesting here, Katie. United Airlines down more than 5% pre-market, but so are its rivals. Of course, a lot of fear under the surface of the trade today.
Well, the thing is, as Nora Melinda was reminding us, it's not just the direct impact of what this is going to mean for travel demand. There's also what this is going to mean for fuel costs. Again, if oil prices really raise sustainably from here, that creates a whole host of issues for a number of different industries.
Daisy chain of issues, and we are seeing, of course, at least the pre-market moves wiping out the week's worth of gains. We are less than 4 minutes to the opening bell. We're going to bring in Rebecca Patterson of the Council of Foreign Relations. This is Bloomberg Open Interest.
All right, we are moments away from the start of trading on this Friday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We've been talking all week about how we've been waiting for a catalyst, and for better or worse, we have one this morning. You can see futures lower across the board as we count down to those opening bells after Israel struck Iran, and there's promise from the Prime Minister of Israel that there's more to come. You can see the S&P 500 down about 0.9%. As Sonali was telling us, if these losses hold, that will wipe out this week's gain. That would end 2 straight weeks of gains for the S&P 500. But nevertheless, you can see the bells ringing, of course, the market opening on this Friday morning. And Sonali, there is plenty to talk about.
Yeah, there really is. Under the surface, let's take a look at what's moving here. Markets are reacting to Israel's attack on Iran, and you're seeing, of course, not surprisingly, oil stocks higher. We're looking at ExxonMobil up by almost 2% as the market opens. Lockheed Martin, also not surprising. Defense stocks are also higher, about 1.6% higher at the market open. Zim Shipping also moving higher by the tune of 2.7%. Remember that oil and shipping story very closely linked, and the direction of travel here between oil and shipping is this idea that prices will be higher moving forward.
And you can see that in the travel stocks as well, which are some of the biggest movers to the downside this morning at the opening bell. You're watching Delta, Norwegian Cruise, Airbnb, all lower this morning, with the airlines, when it comes to Delta, being one of the biggest losers. Let's break down this market and the state of the world, really, with Rebecca Patterson. She is former chief investment strategist for Bridgewater. She's now a senior fellow at the Council on Foreign Relations. I can't imagine a better voice to have on this morning. It's great to see you.
Nice to be with you guys, too.
So let's talk about the cross-asset picture right now, because you're seeing a rush into the likes of gold. You're seeing oil higher. You're seeing stocks fall right now. But we were just having this conversation with our own Will Kennedy about how it feels like when you look cross-asset, we never tend to hold on to the risk premiums built in for geopolitics for very long. Do you think that this episode could be different?
It always could be different. I think historically, when we have these geopolitical events, they're short-lived. There isn't broad contagion. And so people quickly take profit on these risk-off trades, so to speak. But there is always the chance that it could escalate, that there could be contagion. So anything that disrupts supply chains through the Strait of Hormuz, not only for energy, but broad supplies, that would be a big red line crossed. Depending on the retaliation Iran conducts on Israel or other places, that could also be another red line that could prolong this. But really, you have to think about, regardless of the horrible humanitarian issues here, does this have a prolonged, impactful effect on the global economy? Right now, one day, no. But if it lasts longer, so it's duration and it's also breadth of the conflict that we want to watch for.
The scale of the attack was large.
Yeah.
Now, when you think about the potential retaliation, as you're saying, as well as the ripple effects moving forward, what's the sense here? When you talk to your colleagues over at the Council of Foreign Relations, is there a sense that this is more likely to escalate or de-escalate over the coming months?
I mean, there's always room for policy mistakes. That's the thing I'm probably worried about most right now, that there's just a misjudgment among any of the parties involved, including the United States, right? If anyone misjudges what anyone else is saying, or there's just conflicting signals coming out of our government, any of those things could easily create an escalation that's really not intentional. So that worries me quite a bit. Iran is in a difficult place economically. That could be one factor that pushes them to come to the table sooner than they might have otherwise. But they're going to feel like they need to retaliate. And the question is, can you have this tit for tat without a policy mistake, militarily or otherwise, that creates that bigger contagion that then becomes an economic and market issue?
Well, let's talk about what this means for investors and what actually is a haven asset. You're seeing gold rally today, but that's really continuing on a rally that we've seen over the past several months. You're seeing the dollar come back as a safe haven asset. It really hasn't been acting as such. It's been breaking down. It hit the lowest level in years just yesterday. Do you think that this has sort of redefined how investors are thinking about the dollar?
I think the DXY index, so trade-weighted dollar, is up less than 1% today on the back of this. And I think exactly to your point, the fact that we've had such a large sell-off in the dollar year to date, almost 10%, which is a huge move for a trade-weighted currency, the fact that we've only rallied 0.7% today tells me that there's still this structural nervousness around the dollar as global investors reallocate slightly away from the U.S. Gold, to me, is the risk-off trade, so to speak, that I think has sustainability, in that even if, and hopefully, this crisis calms down very quickly, you still have other drivers of gold that are likely to remain. And I think the big ones include central banks, especially emerging market central banks, continuing to diversify reserves into gold, retail investors. Retail investors in the United States, their gold allocations are generally between 1% and 2%. Many are zero. If you start getting more worries about treasuries as that historical safe diversifier, even a very small shift into gold as a complement to bonds can be a big upside for gold prices. So that's the one, if you're going to be in these risk-off trades, that's the one that I don't think you'd want to take profit on.
I'm glad you brought up the treasury market. Katie and I were talking a little earlier about the push-pull that's happening here. This idea that you could have worries about where the economy goes from here, but if oil is spiking to this degree and remains elevated, if shipping rates come under significant pressure, then the inflation story becomes all the more difficult. How does that play out, you think?
Well, it's interesting, too, because you are seeing just next week, we have several central banks meeting, including the Federal Reserve. And the Fed, I think, is going to be continuing to be just, we're watching, we're waiting, we can move in either direction as needed. Other central banks are going to continue to cut, including the Swiss National Bank, which I think by the fall is going to have negative interest rates again because of its currency strength, the dollar weakness. The Swiss franc is too strong. It's hurting them. So you're getting the push-pull, not only in the Fed, in that it has to be careful, but globally. And the risk of a currency crisis or contagion from currencies, it's simmering, but it's going up.
You know, it's interesting, just to hammer that point home for a minute, flew just back from Hong Kong. The biggest worry there is the changes in the carry trades that are happening. The Swissy being kind of the new haven here, the Hong Kong currencies here also fueling the U.S. trade. If that comes under pressure, what else unravels?
And a very difficult time for that when we're going into the G7 and we have an administration very focused on currencies and countries not using those currencies to have unfair trade advantages. That includes things like intervention. So when you have Hong Kong, you have Taiwan, you have a number of countries intervening to try to not let their currencies strengthen too much against this broadly weaker dollar. Can they explain that? Will the Trump administration accept it, or will it make some of these trade negotiations more difficult?
Well, another asset class that we know this administration is focused on is the Treasury market. And I want to talk about that a little bit more directly here, because coming into this week, the narrative was very much, okay, we have these auctions coming up. There were a lot of concerns about a buyer strike. The auctions went fine. We were very nervous about the CPI data, both CPI, PPI coming in cooler than expected. And now a little bit of a haven bid, maybe showing up in the long end, not as much in the front end. But give us the temperature of the bond market right now, because it feels like we can't exactly decide what's going on there.
Well, to the degree we have growth worries, so things like continuing jobless claims, continuing to tick higher, to me, that's an early warning sign that the labor market might be softening further. Those sorts of things can still lead, especially your retail or your asset manager client, end client. They might be switching their stock bond allocation in a typical 60-40 type portfolio. That's going to push yields lower. However, when you have worries about the reconciliation process and the next fiscal bill and what that's doing to our debt supply and the amount of bonds we need investors to buy, that creates an offsetting pressure. My best case for the Treasury market this year is that it's in a range, that it just doesn't move much. If we have a deep recession, which is, I don't think, anyone's base case now, you could see bond yields lower. But in that case, stocks are going a lot lower, too. I think the bias of risk is that bond yields are flat or higher over the course of this year. I don't expect the rally that we're seeing in the 10-year today to persist unless we get some really ugly jobs numbers and other hard data soon.
It feels like, for better or worse, the 10-year yield is glued to 4.5%. So you might get your wish there. Rebecca, so wonderful to speak with you today. That is Rebecca Patterson of the Council on Foreign Relations. And in the next hour, we'll bring you our exclusive conversation with UK Prime Minister Keir Starmer on geopolitical risks as G7 leaders gather in Canada this Sunday. That's coming up. But let's take a check on this market right now. The S&P 500, it opened about 1% lower. Some of those losses are coming back right now, but we're still down meaningfully when it comes to the S&P 500 on the day, lower to the tune of about 0.6%. You can see we clearly have more losers than we do gainers. 120 stocks in the green right now. Up at the front, it's what you would expect. We have some of those energy names in the likes of Exxon. You also have Oracle up here as well. Remember, it had a good earnings report this week, still being rewarded. Eli Lilly up there as well, as too is Lockheed Martin. On the downside, though, and this helps explain why we are lower on the benchmark level, NVIDIA down by 1.4%. That's a big weight. Visa, MasterCard, Apple, Broadcom also dragging this benchmark lower. And you're seeing that play out on the sector level as well. Only 2 sectors are in the green if we look at it that way. Energy up top, of course, having a wonderful Friday on the heels of this geopolitical risk premium being built into that sector. Energy up 1.3%. Staples a little bit higher, but only about 0.1%. And then it just gets red from there. At the bottom, consumer discretionary, tech, and financials off by about 1.7%, Shanali.
And coming up next, we're going to talk about the technology world. A beat and raise from Adobe does not impress investors much. We're going to talk about the tech sector next. Stick with us. This is Bloomberg Open Interest. This is Open Interest, and you're looking live at the Principal Room. Coming up next hour, more special coverage from Le Mans, France, with Aston Martin CEO. Stick with us. This is Bloomberg.
Welcome back to Open Interest. Let's take a look at this market. We're about 14 minutes into the Friday trade. You can see the S&P 500 trying to recover a little bit, now down about 0.7%. We opened more than 1% lower by a hair. You can see some of that coming back right now. And it's the same story if you take a look at the NASDAQ 100. If you take a look at the small caps in the Russell 2000, we'll keep an eye on what's going on here. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, McDonald's getting cut over at Argus. The analyst says that traffic trends will remain weak as consumers push back against price pressures. McDonald's almost perfectly unchanged right now. But next up, Newell Brands getting upgraded to a buy over at JP Morgan. The firm says that the parent of Rubbermaid and Yankee Candle is actually tariff advantage, given that it has U.S.-based operations. Shares up slightly right now. And finally, we end with Oracle getting raised to a buy over at BMO, saying that the software company can grow its operating income. It had a blockbuster earnings report this week. Shares up another 1.9%, Janali.
We're also watching shares of Adobe. The software maker issued a sales outlook for the current quarter that topped analyst estimates, but analyst concerns over its AI business persist. You're watching shares down almost 7%, bringing year-to-date losses to more than 13%. We're going to bring in co-host of Bloomberg Technology, Caroline Hyde. Why so worried?
Yeah, they just cannot shake the bearish narrative on this stock. They cannot shake the fact that there's Midjourney coming for their lunch. OpenAI is coming for their lunch when it comes to Sora. That they've got all of these companies managing the startups to really do generative AI in imagery and in video really rather well. And so this overall actual growth, and as you said before the break, it was a beat, it was a raise, just a small raise, but still they're trying to paint the picture of revenue going up. It's more than 11% growth, but they really can't fight back the narrative that has consumed them, that they're kind of a losing software company within this particular competitive environment. So we are seeing, in fact, only one analyst says sell this stock. Most think that it could outperform, but no one seems to be buying into that.
Yeah, you take a look at Adobe shares down almost 16% on a total return basis over the past year. In some ways, what you're saying reminds me of the narrative that has really developed around Apple being behind in AI, a narrative that it seems like neither company can really shake free of.
But Adobe's actually showing growth in generative AI adoption within its products. Firefly's been doing well. They say 2.4 billion pieces of content have been created using Firefly since its launch. But that just doesn't seem to make up for the fact that everyone thinks the competition is really so stiff when it comes to the advertising applications, when it comes to these new companies. So really they're going to have to do something quite significant to change hearts and minds here. Analysts time and time again just saying this just doesn't change things enough.
I want to switch gears for a moment here and talk about the broader tech world and Meta in particular.
Oh, yeah.
Just quickly want to pull up what's happening with the Mag 7 today because, of course, it is a hugely risk-off trade, yet Meta is still at the top of the pack. Investors are still not looking to sell it off too much. They seem to like that scale investment and where it's going.
Scale it is in name and nature because it's a huge amount of money. They didn't disclose exactly how much they're paying for their 49% stake in Scale AI, but Scale AI came out and said, look, we're now valued at $29 billion, so you do the math. They're basically parting with more than $14 billion for an acqui-hire. And this is something we're seeing time and time again. Basically anxiety consuming the key players in generative AI. They are willing to almost play a game of chicken with the FTC and regulators here to do these sorts of acquisitions that are acquisition in kind of reality but not nature. They take a non-controlling stake, but they license the technology. You've seen Amazon do it with Adept. You've seen Microsoft start this whole narrative last year when they bought out basically all the talent from Inflection and AI. They paid for the licensing of the technology, but they left a carcass of a company behind in its wake. And we've also seen other companies, key companies, Google, Character AI, do a similar thing. They're paying up for talent. This is an extraordinary hire. Alexander Wang coming in. He's going to be leading that so-called sort of artificial general intelligence team that Mark Zuckerberg is currently...
Super intelligence,
yeah,
right?
he's
28 years old.
28, yeah. What a payday for that 28-year-old.
And his female co-founder that's no longer with the business, but I think at one point she was deemed the most wealthy, self-made billionaire out there, topping even the likes of Taylor Swift.
There's definitely worse things to be called. Caroline Hyde, great to see you. That is Bloomberg Tech co-host Caroline Hyde. You can catch more of her and Ed Ludlow at 11 a.m. But stay tuned because coming up on Open Interest, the race to the bottom for ETF fees, it may be over. We'll discuss where the competition is heading next. This is Open Interest.
This is Bloomberg Open Interest. Let's get a check on the stock market right now. We are off of session lows for the S&P 500, but still down more than 0.7%. More pain in the Russell 2000. Real risk-off attitude, 1.3% lower. The VIX is below 20. That's kind of interesting to take a look at here. But the dollar is on the rise, so is gold and crude. Now up about 6.7%. We're watching that closely. You had Brent in particular get up to $78 earlier this morning. We were seeing some of that calm down. On the heels of those moves in cross-asset, though, you were seeing this across the market into stocks as well. Exxon, Lockheed Martin, Diamondback Energy, energy stocks, defense stocks, all on the rise. Travel stocks a lot lower, and tech stocks feeling a real risk-off attitude, Katie. A lot going on in this market.
Absolutely. We'll continue to track that. But let's turn our attention to my favorite thing, and that is the ETF industry, because there could be a big sea change here if the race to lower ETF fees is over. According to the latest research from Bloomberg Intelligence, flows to the lowest cost funds are declining and issuers are shifting the competition to products. Bloomberg Intelligence ETF analyst Athanasios Sarafagis joins us now. So Athanasios, we've been talking and writing about for a while how the new ETFs that are being launched are higher costs, and that was because of active. You can charge more for active products. Does that also explain what you've uncovered in this latest research?
It does, and it kind of goes against everything we know about ETFs, right?
Yeah.
That they're cheap, but it's, to be frank, it's not about ETFs are still really cheap. It's just about the way new money is getting allocated, and it's because they've been so cheap for a while. Investors have saved so much money, they now have this budget that they can go into things like active, or they can buy single stock ETFs or crypto. So it's just the way money's being allocated. You still have to remember 60% of the assets are still 10 basis points or less. So it is still a very, very cheap industry. But because of that, people are willing now to spend a little bit more on these very differentiated products.
Yeah, to that end, how smart are investors on the fee structures realistically? We're talking about a matter of basis points, but if you're buying a private credit ETF, it's going to cost you less than going into a fund itself. Do they still care that the cost is higher than going into regular way market ETFs that cost next to nothing?
Yeah, no, that's great context, because if you compare it to, say, a mutual fund or a hedge fund, it's still a lot cheaper, right? So this is expensive in the context of the ETF industry, which is the average fee is still something like, let's say, asset weighted. It's still only a couple basis points, right? And that's thanks to Vanguard and BlackRock that have really brought that cost down. But issuers are now learning to live alongside them. They're not going head to head with Vanguard. It's just really too competitive. So they're saying, hey, if I could just get a little slice, I can charge a little bit more and just learn to live in this world where Vanguard is going to just be the core of your portfolio.
Right, because from the issuer perspective, there's really nothing to be gained from launching another ETF that tracks the S&P 500, that charges 3 basis points. Yeah. You're not going to win any market share that way. So, that now that we're seeing this trend, that issuers are launching more expensive products, that seems to be where the money is going from the investor side as well. Is one of the net effects here is that issuers are making more money?
Yeah, and it's a good thing, right? So we always look at the league tables by assets, but they're looking at it based on revenue, right? That's what really they care about. So it's like something interesting like First Trust, which is a fraction of the assets of Vanguard, makes just as much money. So to them, that's great, right? But I agree, it can't be a charity business, right? They still need to be making money, and if they can generate some revenue from these high-cost products, that ends up funding other innovations, right? So they're able to launch different products, they're able to focus on other things. So I think overall, it's a good thing. It's still really cheap for the investors. The issuers make a little bit more money, and they're able to keep funding innovation.
All right, Athanasios, great stuff. Really interesting research. That is Athanasios Sarafagis of Bloomberg Intelligence. And you can tune into ETF IQ on Mondays at 12 p.m. New York time. You can also read all about the industry when you subscribe to my weekly newsletter. That's bloomberg.com/ETFIQ newsletter. Many different ways to consume ETF content when it comes to Bloomberg's coverage. Let's take a look at markets really quickly. Of course, it has been a turbulent Friday, to put it mildly. You can see the S&P 500. It was coming back a little bit, now moving back to losses of about 0.8%. Big tech also down to a similar degree. It's the Russell 2000, the small caps, that are seeing the biggest losses today. I find that really curious, Shanali.
We've broken below 6,000 on the S&P 500 and erased all of the gains for the week.
Well, coming up in the next hour, we get University of Michigan consumer sentiment data, plus more special coverage from Le Mans with our own Matt Miller. Don't go anywhere. This is Open Interest.
We are 30 minutes into the trading day, and we are back near session lows on the S&P 500. A real risk-off attitude in markets, with the 10-year hovering just below 4.4% at 438. Brent crude still on the rise, but not as much as this morning. Katie, a lot going on under the surface.
Absolutely. It's interesting to not see bonds cooperate with that risk-off bid that you're seeing when it comes to gold, when it comes, of course, to equities. We'll have to see how that develops.
Yeah, it's interesting. We have breaking news data at the top of the hour. We're going to bring in Michael McKee. We are looking at Michigan June consumer sentiment data rising in the middle of all of this macroeconomic confusion.
Well, I hate to come out. I keep coming out and telling you that the numbers may not matter, and these numbers may not matter because of what is going on right now. But Michigan sentiment up a lot, 60.5 from 52.2. Current conditions, 63.7 from 58.9, and 58.4 for expectations from 47.9. The gloom is gone at the moment, or at least it was when they ended this survey. One-year inflation drops to 5.1% from 6.6%, a huge drop, and 5 to 10-year inflation, 4.1% from 4.2%. So at this point, people are telling the University of Michigan they think inflation is going to be lower than anticipated and that the economy will perform better. But of course, with oil prices now up where they are, we don't know if this is going to be what we see for the long run in terms of gasoline prices, and that may change people's views going forward. So the revision that we get at the end of the month will be important. Let me just point out here that this survey gets knocks for being political now somewhat. Democrats actually increased their views of the economy, 35.2 from 34.4. It's a very small move at a very low end, but they're feeling better about things, while Republicans are less, 87.9 from 90.2. So go figure time.
Go figure.
Well, it seems that markets agree with you that this particular set of data doesn't matter. The S&P 500 still holding near its session lows as traders really unpack what's going on in the Middle East. Bloomberg's Michael McKee, thank you. And on that note, the escalating conflict between Israel and Iran has provoked international response from the Middle East, America, and from Europe. UK Prime Minister Keir Starmer is among the leaders calling for de-escalation. He spoke with Bloomberg Weekend editor-at-large Mishal Hussein in an exclusive interview from 10 Downing.
Well, I'm very concerned about the situation that is developing, and it's obvious that for a long time we've had grave concerns about the nuclear program that Iran is putting together, and we absolutely recognise Israel's right to self-defence. We, the UK, were not involved in this attack, and we're urging all sides to de-escalate and negotiate as the way forward here. And obviously we're talking to allies about that. We have been this week. We are intensively talking to allies today.
In March, US national intelligence made it public that they did not believe Iran was developing nuclear weapons. So has something changed in the assessment since then?
Well, I won't go into the intelligence assessments, but we are gravely concerned. I've just had a call with President Macron and Chancellor Merz to discuss the situation, and we are all on the same page in the sense of saying, look, the nuclear program is a real cause for concern. We're all saying de-escalate in relation to this incident, but none of us were involved in the actual attack.
Does that mean you're also gravely concerned about the fact that Israel has taken made this very big move, preemptive military action? I mean, you're concerned about Iran's nuclear program. Are you also concerned about Israel's choice of action?
Well, I'm concerned about escalation, of course, and I'm going to speak to Prime Minister Netanyahu shortly after this interview. So obviously that'll be a topic of discussion. Look, I do recognise Israel's right to self-defence. There's no doubt about that. But I am very concerned about the escalation of this situation, which is why, along with Germany and France, we're really clear that de-escalation is what is needed here.
Would the UK therefore help defend Israel from Iranian attack as it has done before? Well,
This is happening, in real time as we speak, and I'm not going to go into operational matters if you'll forgive me for that. But as I say, the principle of Israel's right to self-defence is absolutely clear, and we stand by that. But this is a fast-moving situation, as you will understand.
At the same time, we have the ongoing situation in Gaza, the suffering there, something that you have called intolerable and appalling. 3 weeks ago, you made this very strong statement with Canada and France, which called for three things: for Hamas to release the hostages, for Israel's military operations in Gaza to cease, and for Israel to let aid into Gaza in accordance with the UN, engage with the UN in delivering it. None of those things have happened. What action will you take now?
Well, you'll have seen that we've taken action in relation to sanctions 3 weeks ago, but also more recently. And it is important that we consider what other options that we have. I always think in these situations it's better to act with allies, which is why we're coordinating what we're doing. But the situation in Gaza is absolutely intolerable. The aid arrangements are not adequate, nor are they going to be adequate. And so that's why we've been consistently calling for a return to the ceasefire. Of course, the release of the hostages, the remaining hostages who've been there a very long time in awful circumstances. But we must get that aid in at speed, at volume. And the current arrangements are not going to deliver that. And that's why we've been very clear in our messaging on this and our coordination on this and our willingness to take action such as sanctioning.
Which you've already done. And as I said, there's been no change to the situation. An action you could take is recognising a Palestinian state. And President Macron is leading on a conference at the UN next week on that very subject.
Well, we've got long-standing policy as a Labour Party, as a Labour government, that recognition should be part of a process, and so that's our approach. Precisely what's going to happen in the conference next week, I think, is unclear, and obviously now the immediate issue is the Israeli attack overnight, and so there are a lot of moving parts at the moment. But the principle we've always held is that the only long-term solution in relation to Palestine and the Middle East is a two-state solution. And although it seems further off now than perhaps it's seen for some time, we have to be clear that is the only path through, and that recognition at the right part of the process has always been our long-standing policy.
That was UK Prime Minister Keir Starmer speaking with Bloomberg Weekend editor-at-large Michal Hussein in an exclusive interview. That conversation coming ahead of the G7 Leaders Summit in Canada, which starts this Sunday. We're going to bring in now Bloomberg correspondent and the Big Take podcast host, David Gura, who will be at the summit. But on set with us right now, David, the UK has been a relative golden child in these trade talks between the US and international counterparts. What about the rest of the EU, though, heading into G7?
So this will be something that's not on the official agenda, but certainly going to be talked about at meetings on the sidelines. And I think that it's safe to say every member of the G7 is kind of jockeying for an interview with President Trump on the sidelines of that summit, of that leaders summit. So the EU is optimistic, I think, that they're going to be able to have one of those meetings, first of all, and make some progress on those talks. But you're right to say it's a priority for the UK as well. And Keir Starmer, in that interview with Michal Hussein, talked about the fact that he has been in touch with President Trump, somewhat regular contact, just about kind of adding more meat to the bones of that very skeletal deal that they signed a couple of weeks back. So again, this isn't an agenda item, official agenda item at the G7 Leaders Summit, but something that's very much looming in the background.
A skeleton deal, but still a deal. It feels like it's one of the only, if not the single country that has a deal with the U.S. But let's talk about the tone and the types of conversations that will be had following what we saw overnight when we saw Israel attack Iran. Prime Minister Benjamin Netanyahu saying that that will continue. How do you think that changes what's going to be happening next week?
Well, you've seen statements from a number of these world leaders who will be there in Kananaskis next week in Canada, and what they're urging is for the situation to be de-escalated. They don't want this to continue in the way that Prime Minister Netanyahu is describing, which is for it to be this kind of sustained campaign. We'll see. I think what's so fascinating about that interview that Michal just did is all of this was kind of percolating and happening in real time. He mentioned that he was going to talk to Prime Minister Netanyahu later in the day. He's trying to get a sense of where this is going and what the broader strategy is. I think that's probably the case in the United States as well. And we're going to hear from President Trump later this morning when he has his intelligence briefing and a cabinet meeting as well. It is an official agenda item meeting at this G7 Leaders Summit, international security and foreign policy. So this is largely in keeping with what's going to be discussed there. There's also a focus, of course, on instability in the region and the situation in Gaza as well, which are all likely to come up in those conversations that take place at the G7 next week.
Right. You know, a lot of this interview was shortly after a call that we saw UK Prime Minister Starmer have with Emmanuel Macron, as well of France, German Chancellor Friedrich Merz as well. How do you expect, given that it is an official agenda item, to play out, especially given at this moment we have not seen an Iranian response yet?
You know, I think it's going to be a very long weekend until this meeting takes place. So I'm reluctant to forecast sort of what this body might say as a whole. I will note that there isn't going to be a communique, kind of a joint statement, the likes of which we've seen at other multilateral meetings like this one going forward. And that kind of highlights the fact that the U.S. is now occupying this unique role in this organization, that it's not that he's an enemy of the group, but he's playing a different role. President Trump is playing a different role here. So, again, I'm reluctant to forecast what might happen here over the course of the weekend, but I think we are going to get more detail and just see how the campaign evolves over the course of the weekend.
Well, I won't ask you to make any predictions, but let's look back in time, because we were talking in the commercial break, comparing and contrasting this G7, the anticipation for what happens next week, to what we saw in 2018. You reminded me that President Trump at the time actually walked out.
Yes, so that G7 back in 2018 took place in Charlevoix, and it ended in a fit of pique from President Trump. He didn't sign on to the communique there, had some critical words to say of the now former Prime Minister Justin Trudeau on his way out, but it kind of has been immortalized both in that moment and this picture where President Trump's sitting there and Angela Merkel, the former chancellor, is kind of standing above him, and you saw the U.S. kind of in this position alone as these allies surrounded him. Look, I think every world leader is cognizant of what happened back in 2018. They want to avoid that, and they want to avoid it just because of the general comedy of the group. They want to make progress here over the course of this meeting, but they're also aware of the fact that there's a NATO summit coming up as well in just a few days, and they want to keep things as peaceable as possible among this group going into that, as that's something that's a big concern for them too.
David, we're going to be watching your coverage very, very closely. That is Bloomberg Big Take podcast host David Gura. You can listen to David, of course, anywhere you get your podcasts. But we're going to get a check on these markets right now, because we are looking at worsening of the trade. We're looking at the S&P 500 at session lows, about 1% lower or more. We're watching the 10-year now at 4.4%. It was a little bit lower in terms of the yield action just really even moments ago. Brent crude now trading at a 74 handle. It has been fluctuating throughout the morning, now about 6.8% higher on the day. We saw it get to 78 earlier in the day, but a significantly risk-off tone here. Katie, I know you're watching some sectors as well.
Yeah, let's drill down to the single stock level here as markets react and digest Israel's attacks on Iran. We start with energy, defense, and shipping stocks surging this morning. Exxon, Lockheed Martin, and Zim Shipping all moving higher here. On the other side of the trade, you do have travel stocks as some of the biggest movers to the downside. We're talking about United, Carnival Cruise, and Hilton all morning, all lower right now. Much more coverage coming up next. This is Open Interest.
And now to high interest, a look at what's making headlines around the world. President Trump said he may raise U.S. auto tariffs in order to boost domestic auto manufacturing, and the move would further ramp up tensions with trading partners. Our own Matt Miller is in Le Mans, France, where he sat down with Ford CEO Jim Farley and asked about his take on Trump's tariff policy.
I think Donald Trump's policies, especially around Asian countries where, you know, they've supported with subsidies, direct or indirect, for their automobile industry, you know, this is a great thing.
And the creative software giant Adobe gave sales outlook for the quarter that topped estimates and raised its outlook, but investors remain skeptical that it could beat its AI competition. Adobe has become a central focus of investors debating whether artificial intelligence tools will disrupt traditional software among industry leaders. Also watching Walmart and Amazon reportedly exploring ways to issue or use stablecoins, a move to launch a payment system that would bypass traditional payment systems, and it could send shivers through the nation's banks and allow those retail giants to save billions of dollars in fees. Watching this very closely. Maybe not impacting the trade today, but will certainly impact money flows in the future, Katie.
Yeah, I don't know who was asking for that, but very curious to follow that story. But let's get a check on these markets in real time, because as we've been talking about, a risk-off day. The S&P 500, the NASDAQ 100, all down right now, but one asset class stands out in particular, and that's the bond market. You have yields a little bit higher across the curve. You can see the 10-year Treasury yield higher by about 4 basis points right now. So let's try to get some answers now from Bloomberg Markets editor Christine Aquino. Great to have you with us. It's interesting to watch what's going on when it comes to the short end and the long end, both rising this morning when you're seeing that haven rush into the dollar, into gold. What's going on with our bond market?
Well, Katie, of course, this again brings up questions over whether the Treasury market, is it still an effective safe haven in these trying times? And, you know, we did see a little bit of that initial knee-jerk reaction when it comes to the initial reaction to the strike headlines, right? But then I think what's playing out now is that inflation impulse that we're really seeing from the spike in oil prices. And particularly in the long end, we've seen that really rally this week because there was a lot of a sigh of relief over the auctions that went well, when there was a lot of worries about whether 10 or 30-year auctions, is that going to be absorbed by the market? And so, you know, that went really well. And then suddenly, Friday, we get this question once again, is inflation about to rear its head and do another number on the bond market?
Well, it's a complicated calculus. It's interesting. Neil Dutta over at RenMac, we've watched really closely, said it's not the rise in oil prices per se, but what the Fed ends up doing as a result. If this just reinforces the hawkishness they've shown, it's a problem, as you've been alluding to. Now, I wanted to pull up the interest rate probabilities too, because you are seeing today, it's not by much, but the Fed futures marginally dipping just under 2 rate cuts expected this year. On one hand, prices could rise. On the other hand, this could cause some weaknesses in the economy. How does this exacerbate that push-pull?
Yeah, absolutely, Shanali. I mean, for the Fed, it's a big headache, right? Because again, as you say, they're going to be caught between a rock and a hard place when it comes to inflation and growth. And they have leaned toward kind of waiting and seeing what the data tells us, waiting and seeing how these trade developments go. And then once again here, probably adding to the Fed's calculus, waiting and seeing how these geopolitical tensions play out. And so, you know, there's an expectation that, for instance, the Fed's dot plot is going to have to be revised. The last time we heard from them on that front, they were looking at 2 rate cuts by the end of this year. Markets are about aligned with that. But, you know, looking forward, we are seeing markets starting to price in for a much more dovish Fed, especially when you bring in the conversation of who is going to replace Jerome Powell. We know that the Trump administration very much in favor of lower rates. And so there is the potential for a more dovish governor to come in.
So something I want to get your take on, where you're sitting on the MLive blog. I'm sure a conversation that you've been having is whether or not geopolitical risk events, whether they're truly getting priced in. We're pricing in perhaps a more dovish Fed, but it feels like you see these pops when we have episodes such as this across the different asset classes, and then they fade. Are we seeing anything to suggest that it might be a different playbook this time around?
Yeah, I mean, interestingly, Katie, you know, we were looking at some of the positioning indicators. There is perhaps a question that are markets too complacent at the moment, because you still have very much a market that is perhaps skeptical of this rally, but also kind of afraid to position themselves out of that rally, you know? And so we have a lot of investors just kind of waiting and seeing, but not really fully ready to commit to divesting away from U.S. equities, because just before, you know, earlier this week, we were having conversations about, oh my gosh, how much longer is it going to take before we reach all-time highs on the S&P 500 again, right? That's back in a conversation. You know, today's news probably tempers that optimism a little bit, but it's not entirely out of the question that we might see those ATHs once again later in the summer.
ATHs, baby.
Christine, we thank you so very much. That is Bloomberg's Christine Aquino, forever brilliant. We appreciate all of your analysis. Let's get a check on these markets. The S&P 500 is lower. It's near session lows, about 1.1% roughly lower. That 10-year yield has been really interesting. It is now up almost 5 basis points, about 4.4% on that 10-year. Really interesting to not see the bond market be the haven it has been throughout the course of the week. And we are seeing, as you've been saying, Katie, so interesting, that 4.5% level really be that sticky point on the 10-year. Brent crude also watching it very, very closely, almost 7% higher on the day. The 74 handle mark has been sticking throughout the morning. We will keep an eye on all moves across assets. Of course, risk-off tone in the heat of geopolitical tension. Stick with us. We'll bring you all you need to know. This is Open Interest. Welcome back to Bloomberg Open Interest. I'm Shanali Basak. Let's get a check on these sectors because it is a risk-off day, and under the surface, this is what it looks like. NVIDIA is the largest points drag, but followed closely by Apple as well. You're seeing a lot of the financial companies take a hit as well. We are watching on the upside on the points gainers. You're looking at ExxonMobil, Lockheed Martin, RTX among the biggest gainers on a points basis. But you are also seeing Oracle really leading the way there. That is a rare mover in the tech world. I want to look at sectors as well really quickly, because you're seeing that risk-off attitude hit almost every sector. Energy being the big exception. We've been talking about it. Oil prices higher on the heels of the geopolitical risk rising across the Middle East. But we're looking at almost every sector in the red. Go through into the financial sector. You'll see where some of that pain is the most. Very interesting here. Almost every company really in the red on the morning. SIBO is an exception there, of course, because if you see more volatile trading, a firm like SIBO would gain. Visa, MasterCard has other things going on. There was a report about stable coins being used among large retailers. That is impacting those big payments companies as well, Katie.
Yeah, we'll continue to keep an eye on that. But coming up next, for the first time in over a decade, Aston Martin returns to the top class of Le Mans. We'll speak to the CEO up next. This is Open Interest.
We'll always face competition. You know, we're positioned well. We got an iconic brand, been here for over 100 years. For us, we've really focused and leaned into what we call back to basics, but it's running just a great operational excellence along with enhancing our customer experience.
That was Gil West. He is the CEO of Hertz, speaking earlier on Open Interest. A really interesting conversation that Matt has been having out there, just one of many. Also speaking with the CEO of Ford earlier today, and it's a really interesting time for a lot of these auto companies. Obviously, there is the tariff picture and the uncertainty over that. President Trump making more news overnight, and then all of the input costs that come along with it. So let's continue our coverage and head back to Le Mans right now, where Matt Miller and Bloomberg's Hannah Elliott are joined by the CEO from another company of an iconic brand that is trying to turn around its business. Over to you guys.
Yes, Katie and Shanali, thanks very much. We're here with the CEO of James Bond's preferred car manufacturer, Adrian Hallmark, here from Aston Martin. Great to talk to you today at this iconic venue. I feel like that word has been almost overused today, but it is true. What does Le Mans mean to you?
As a company first, I think the first time we entered was 1928, which is quite a long time ago. We won it in '59. But more importantly, if you look at today, if I take Valkyrie, which was a hypercar for the road that we turned into a race car to go compete in the hypercar class. So it's a genuine connection, as it was in the origins of Le Mans, between a road car and a race car. Of course, we had to modify it quite a bit to make it work, but it's very exciting.
Talk a little bit about what the brand gets out of the race. Obviously, this is an iconic race. What do you get from it as a company?
I think if you compare it with our Formula One activity, the media coverage is a fraction of the pure global awareness that F1 gets. But if you look at people that are interested in high-performance vehicles, it's much more relevant. So it's a smaller audience, but it's almost self-selecting, because most people that buy supercars, hypercars, sports cars, they love endurance racing. Why? I've used the stats we all have before. Until Formula One got a lot bigger in terms of number of races per year, when it was only 16 races, that's exactly the same as a 24-hour race. So Le Mans is the same as a full season of Formula One back 10 years ago, and faster. So from a technical challenge point of view, a people challenge point of view, it's got to be the most demanding, incredible sport in motorsport.
How do you deal with the tariff situation as a manufacturer that cannot produce cars in America? I mean, the whole point of buying an Aston Martin is buying a British sports car. So what can you do?
So it's been a challenge for us, and I think the fact that it's been reduced down from what could have been quite significant to 10%, still 4 times what it was. But if you break that down, with a little bit of work between us, the dealers, and our customers, we can get through this. So clearly we're still waiting for this to be activated, and we're reassured that that will happen in days and weeks, not months. So it's been agreed but not implemented yet. But we took plans ahead of time in anticipation of this. So we stopped shipping cars for 2 months. We did them all early. We've hung off a little while. It should shake out. We're ready to go end of June, early July. Watch this space.
Okay, so talk to us a little bit about sustainability at Aston Martin. Where are you guys with sustainable powertrains, and what are you taking from the racing that we might see in the cars in the future?
So I think from a Le Mans point of view, it's probably the furthest away from our sustainability strategy. Why? We have no hybrid. We've gone for a naturally aspirated 12-cylinder engine, which is what makes the Valkyrie Le Mans car so incredible. There's nothing else on the track like it from that point of view. But if you go to the road cars, we've just launched Valhalla. It's a hypercar. It's 2.6 seconds to 62 miles per hour, over 1,000 horsepower, carbon fiber tub, hybrid system, front electric axle, high power V8 engine, and a motor in the gearbox too. Combination well over 1,000 horsepower. That's our first plug-in hybrid for the road as a regular car. Over the next 5 years, all of our cars will be hybridized. And then within the 10-year window, we'll have launched 1 or maybe 2 electric vehicles. But we certainly see for the next 10 years until 2035, let's say, the majority of our business now will be electrified combustion engine systems that massively reduce real-world emissions, but also give, more importantly, way more horsepower than the current products. And that's the direction that we've taken.
Are you able to get all the magnets that you need, all the rare earths? I mean, Jim Farley was telling us he's got employees putting them in their luggage and getting on commercial flights out of China. Obviously, you make far fewer vehicles, but you still need those things. Are you getting them?
Sure. Well, the great thing about being a company of our size is you won't notice the amount we need. So, no, we have no problem. It's bigger manufacturers with mass production. You can absolutely understand that the challenge to secure for that production high quantities of these materials. But for us, it's not so much of a problem. There is availability. We use small quantities, but very concentrated aspects of them.
I have to ask, when is the next James Bond moment going to be for the company? Obviously, you're so affiliated with James Bond. Yeah. What have you got in the future that we can look forward to?
If I told you, I'd have to shoot you.
That's a very James Bond answer.
It is. That's why I did it. But no, we have no official timings yet for the next Bond. You know that the rights have been bought out by Amazon MGM. So we have a great relationship with the previous Eon Productions. We have a developing relationship with the new owners of the franchise, and we're looking forward to working with them, but there's no plans yet. And I don't know who the next Bond is either. It's not me.
Well, I sat down with Lawrence Stroll at Q, or whatever you call your Aston Martin shop in New York on 57th and Park, and he was doing with me the back of the napkin math of what Aston Martin could be if it got even half of a Ferrari valuation. I'm sure that's the goal that you're aiming for as well. Yeah. What are your plans to get there? I mean, what do you have to do to get investors to attribute that kind of valuation to Aston Martin?
One word: perform. You know, as a company, we've been around for 112 years, and it's been a rocky journey for that 112 years. The brand has endured. It's got a fantastic reputation. The response that you get in an Aston Martin is unlike anything I've experienced. And you know, I've been with great German brands and another great British brand for combined 25 years of my life. You can't stop at a gas station or at a hotel without somebody taking a picture of you or asking you a question about the car. It's phenomenal. So the brand power is there. What we need is a consistent approach to product development, which under Lawrence and that new investment approach has begun. The first 5 years, if you look at what we've refreshed and what we've delivered, Vanquish has knocked it out the park. We're beating the Italian competitor in road test, hands down. That's never happened before. We've been accredited being better looking in certain products, but never on a track in absolute extreme conditions. The Aston's the best. So we build cars that work, they look fantastic, but we've really got to now, with this transition between the current product range, the hybrid range and electric, we've got a whole strategy, which I can't talk about in detail today, which will rely on less volume growth, more quality of margin, quality of business, operational excellence, all the quite boring stuff that makes great companies even greater. We've all done it before, and that's what we intend to do here. So we've got the brand, we've got the performance, we've got the design. We've now got to make the business as beautiful as the cars.
You just got to win on Sunday and sell on Monday. Adrian, great having some time with you. Thanks so much for sitting down with me and Hannah. Katie and Shanali, back to you in New York.
Matt, Hannah, excellent interview. I myself am a massive, massive James Bond fan, so looking forward to seeing them unveiling what's going on. That is Adrian, Hallmark of Aston Martin, as well as Bloomberg's Hannah Elliott and Matt Miller. Matt's got more from Le Mans ahead with racing driver Michelle Gatting. We will bring you all of that and, of course, give you a steep check on what is happening underneath the surface of these markets. Stick with us for all you need to know. This is Bloomberg Open Interest. This is Open Interest, and you're looking live at the Principal Room. Coming up tonight, the latest episode of Wall Street Week. That's at 6 p.m. New York time. This is Bloomberg. Investigators are combing the wreckage of the Air India flight to determine what caused the Boeing Dreamliner to crash yesterday. The tragedy killing all but one of the 242 people aboard and resulting in the deadliest aviation accident in over a decade. Bloomberg's Brooke Sutherland covers industrials for us, joins us now from Boston with the latest. How are people looking at what happened actually when it comes to this crash?
There's still a lot we don't know, and it's early in this process. Some of the aviation safety experts that Bloomberg has spoken to have raised questions about the landing gear, the flaps, the potential weight calculations that were on board the airplane. But again, we're really just waiting to get more information. They have recovered one of the black boxes on this plane, which is crucial to figuring out what exactly happened, what was the sequence of events that led to this very tragic accident.
And Brooke, you made the good point yesterday that, it's too soon to even know whether Boeing was at fault here, what the actual cause of this tragic accident was. The shares haven't been behaving that way. It seems like shareholders and traders not waiting for those answers. Boeing shares down pretty sharply this week. This all comes ahead of the Paris Air Show kicking off on Monday. We know that Kelly Ortberg was scheduled to attend. It looks like he has since pulled back. What does this mean for Boeing's turnaround efforts?
It's certainly not helpful for Boeing's turnaround efforts. Just they've really been trying to move beyond the series of safety incidents, and there were signs that they were able to start doing just that. They've been improving production processes on the factory floor, increasing output of that all-important 737 MAX jet. They've won some really substantial orders lately, and it seemed like finally, maybe Boeing was starting to turn the corner on this really rather tragic era for the iconic company. So again, we really don't know at this point the extent to which what happened involves the design of the aircraft or anything whatsoever to do with Boeing. But I think just given what this company has been through over the past couple of years, investors are sort of jumping to conclusions first before we get the details and looking to hear a little bit more about what happened here.
Brooke, I know you'll be watching this closely, and I know investors will be wanting to hear from CEO Kelly Ortberg soonest. But to switch gears for a moment here, because given what we saw over the last day or so in terms of the escalation of tensions between Israel and Iran and tensions brewing in the Middle East, you are seeing travel stocks take a significant hit. Of course, this is because of what you're seeing with oil prices, of course, consumers and their inclination to travel as well, given the tensions abroad. What can you say about the direction of travel, so to speak, here for these companies and the companies that are really being impacted by the trade today?
Definitely. And to your point, oil is one of the biggest expenses for airlines. And so it is typical that you would see airline stocks reacting to any big swings in oil prices. But at the same time, this is another safety incident coming on the back of several really kind of jarring aviation experiences. And I think that that's very difficult for a lot of consumers who have come to expect air travel to be, one of the safest modes of transportation. And I think that just sort of compounds the uncertainty at a time when air travel was already under pressure domestically as inflation really started to bite and consumers pulled back. And then you were seeing a dip in international inbound travel into the U.S. in part because of some of the political dynamics taking place right now from the Trump administration. And I think what had really stood out was that international outbound travel from the U.S. And from other countries to other places besides the U.S. had really been strong. And now I think looking at this series of events between the crash and then what's happened between Israel and Iran, you do have to wonder, can that international leg continue to hold up? Can that continue to be a growth engine for the airlines, or do we start to be concerned about that taking a hit as well?
Certainly a very, very complicated calculus. Brooke, we appreciate your reporting. Thank you for joining us. Of course, Bloomberg's Brooke Sutherland from Boston, very steeped in the sector, and we'll bring her more news from you as we get it. Now let's get a check on these markets. We are seeing the S&P 500 hold on to losses for the day, almost 1% lower, off of the very lowest we've seen of the session, but quite close. That yield rise in the 10-year has been very interesting. Now more than 5 basis points higher. We're at 441. We're very well off the highs of the year, but it has not been acting as that haven bid you would normally see in the Treasury market at times like these. Yet oil is still higher, 6.7%, holding on to that 74 handle. We will keep an eye on these markets with you. Stick with us. This is Open Interest.
Welcome back to Open Interest. Let's head back now to Le Mans, France, where Bloomberg's Matt Miller and Hannah Elliott are joined by a member of the Iron Dames racing team.
Katie, thanks very much. Yeah, Hannah and I are joined by Michelle Gatting here, and we're pretty psyched to talk to her because it's such a cool team, and I guess there's so much attention given to you guys, an all-women's racing team. Talk to us about how it started. I think you were there from the inception, and how you guys are doing.
Yeah, first of all, thanks for having me. I mean, yeah, the Iron Dames was born in 2018. It's an all-female project that is supporting women in motorsport, not only as drivers, but as engineers, mechanics, on the marketing side, because the sport it's huge, and it needs people like women as well. And the project is special because we are an all-female lineup, sharing a car, three women racing against all the others. In the end of the day, like we always say, when we put the helmets on, we are race drivers like anybody else. But we definitely want to give female drivers a chance to be seen out there, because that's what's been missing over the years. And I think what the project has been doing since the very beginning in 2018 is really been showcasing that women can compete on the same level as men in the highest level of endurance racing. We have won races in the World Championship and the European Championship, and we are proving that we can race alongside the men, and we can beat them in best case scenarios.
Michelle, you've been racing for years. What does Le Mans specifically mean for you as a driver?
Le Mans, 24 Hours of Le Mans is just such a special event. I mean, it's really the event of the year. It's the event that all drivers, teams, manufacturers, it's the event that everybody's preparing for, because it's a 24-hour race. It's so different to all the others because it's a long race. The cars need to last. The mechanics need to last. The drivers need to last. So there's a lot of preparation done from everybody. It's really a team effort. I love to come back here. It was supposed to be my 7th time this year, together with the Iron Dames. I will be on the sideline this year, supporting my team, supporting my teammates. Unfortunately, hopefully I will be back next year. But really, I can just say to everybody, enjoy it. Follow the Iron Dames car 85 in LMGT3, because I'm sure they're going to be kicking some ass out there.
You're in a cast because you dropped a car on your foot. Obviously, that's unfortunate. How do you prepare for this kind of grueling event? I mean, even if it's divided between 3 people, 24 hours is so difficult for every driver. It's so difficult for the mechanics. It's so difficult for the engineers. I mean, what's it like?
Yeah, what's it like? I mean, like it's such a team effort. You cannot do it alone. I cannot do it without my teammates. The teammates cannot do it without me. We cannot do it without our engineers, our mechanics, and all the people around the project. Like just coming here, you know, I need people to drive me here. We have marketing people. So it's a huge team effort. Preparing, there's a lot of physical preparation, there's a lot of mental preparation, because you arrive here, there's a lot of pressure coming from the outside. There are 300,000 of people here. All of them want to get a bit of you, you know, autograph signing, pictures and so on, which And all of this is happening before the actual race starts, which is not before tomorrow, but the whole week leading up to that race. It's so demanding, and it takes a lot of preparation. But like I said, we have the best people around us to push us, to prepare us, and I was ready. I know my teammates there are 100% ready, and yeah, now let's go green flag and let the race begin.
I just want to ask, because I have a couple of daughters at home, 4 and 1. They're watching racing with me every weekend. What do I do to get Edna and Lola into this sport, to get them prepared and hopefully to a higher level?
Well, the first thing you should do is bring them to a race. Bring them down to the Iron Dames garage and show them that there are 3 ladies there who is proving to your girls that it's possible, because we had a dream when we were their age, you know. Back then, when I was very young, it was difficult to have somebody to look up to in terms of female drivers, because there was not really any. Now, hopefully, we are the drivers that your 2 daughters can look up to and say, yeah, but they are doing it. Because with hard work, dedication, and passion, and commitment, you can do whatever you want in life. And this is what we want to showcase with the Iron Dames project. Where there is a will, there is a way, you know. And all of the athletes, which is a part of the Iron Dames, let's say the Iron Dames pool, they have this attitude which you need as an athlete. So that's what you need to do. Bring them to the Iron Dames garage and show that there are 3 badass girls that are driving the Porsche around the racetrack as fast as possible.
I will take you up on that. Michelle, thanks so much for joining us. Michelle Gatting there from the Iron Dames team here at the 24 Hours of Le Mans. Katie, Shanali?
Matt, thank you so very much. Looking forward to when Lola and Edna will be behind the driver's seat, as well as the rest of your coverage in Le Mans, France. And for more on the 24 Hours of Le Mans, you can check out the special program on the race. That will air next week. We'll be looking forward to it. Of course, you might have missed it a little earlier. All the talk about James Bond and Aston Martins. There's a lot of cool things to take out of what has been happening at this specific event with Matt Miller and Hannah Elliott. But let's go to check on these markets before we let you go. We are looking at a lot of softness in the market more largely. We've looked at the S&P 500 really wipe out most of the gains for the week. It is on the edge right now. We are off of session lows. We are only about 0.8% lower. We were below 1% lower at some point in the trade. 440 is where the 10-year has been hanging out, around 5 basis points higher. Not really seeing that haven trade hold up. Brent crude, though, now under 74.
I do want to talk about the S&P 500 a little bit more, because we're still hanging out around 6,000. So that really puts it into perspective what we're talking about here. I will also note that we're having these conversations on a Friday, of course, as traders really digest and try to make sense of what's happening in the geopolitical landscape. The fact that it is a Friday, we know that traders have been reticent in 2025 to hold risk into the weekend. That might explain why these losses are holding, but it's going to be a turbulent tape, volume a little bit elevated today, and there's a lot of daylight between now and 4 p.m. Now, this weekend, the Asia trade will start 1 hour earlier than normal. We'll bring you coverage of all the latest developments over the weekend. You can catch that Sunday starting at 6 p.m. This is Bloomberg.